Stablecoins are supposed to act as anchors in the crypto market, tethered tightly to their reference currencies. But when EURR, a euro-denominated stablecoin issued by StablR, fell 20%, it sent shockwaves through the stablecoin ecosystem. USDR, StablR's dollar-pegged stablecoin, stopped tracking EURR in the way traders and liquidity providers had come to expect. This decoupling is a rare and significant event in stablecoin markets, where most stablecoins maintain tight price correlations with their pegs. The divergence came after reports of a suspected smart contract exploit affecting StablR. On-chain investigator, ZachXBT flagged a potential $3 million exploit targeting the stablecoin issuer, which appears to have triggered the pricing dislocation between StablR's two tokens. The breakdown in EURRs pegged to the euro raised immediate questions about the health of StablR's reserves and the integrity of its smart contracts. In normal conditions, EURR and USDR are expected to move in sync, as they are both issued by the same entity and are designed. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. To maintain stable valuations. But when EURR dropped 20%, USDR did not follow suit. Instead, it began to trade independently, signaling that market participants were now treating the two stablecoins as separate risk assets. This shift suggests that traders are no longer assuming that all StablR tokens are equally secure or redeemable. The decoupling reflects a breakdown in three key pillars of stablecoin stability: liquidity depth, redemption confidence, and arbitrage efficiency. When a stablecoin drops sharply from its peg, it typically triggers a chain reaction across its ecosystem. But in this case, the market response was more nuanced. USDR's separation from EURR indicates that traders are now pricing in distinct risk profiles for each token rather than treating them as a single, unified product. This is a sign of deepening market scrutiny and a loss of trust in the issuer's ability to maintain stablecoin pegs. The suspected exploit flagged by ZachXBT may have been the immediate trigger, but the broader issue is the fragility of stablecoin ecosystems when faced with real-world stress. Stablecoins are often viewed as a safe haven in crypto markets, but this event shows how quickly that perception can change. The 20% drop in EURR is not just a technical glitch, it's a red flag for the entire StablR platform. Market participants are now watching closely to see whether the issuer can stabilize EURR's value and restore confidence in its redemption mechanisms. The next signal to watch is most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Whether EURR can regain its peg, and whether USDR remains decoupled or eventually returns to its expected trading relationship with EURR. If the market continues to treat the two stablecoins as separate assets, it could signal a broader shift in how stablecoins are valued and traded. For now, the decoupling is a clear indicator of market stress and a warning that stablecoins are not immune to the same kinds of risks that have affected other parts of the crypto ecosystem.